Hi, everybody. Welcome to Friday's Focus on Finances. My name is Jamie Fleming, and today we're going to do something we do at the end of every year in the fourth quarter. And we're going to talk about some of the year-end tax planning tips we have for you. You want to consider preparing for the upcoming tax season by taking advantage of a few important end-of-year tax strategies. Take action on these tips by December 31st. Then find out if you can potentially minimize your tax burden. And with potential tax law changes ahead, a year-end review is more important than ever. So the first thing is check your paycheck withholdings, whether you're an employee, a W-2 employee, or you're self-employed paying yourself a paycheck. If you claim too few allowances on your W-4, you may end a huge refund at tax time. This may seem well and good, but you're basically lending the IRS your money interest-free for more than a year. If you adjust your allowances, you can increase your monthly cash flow and put that extra money to work for you towards your financial goals. If you claim too many allowances, you may have taxes due. To avoid this kind of surprise in your own filing, use the IRS tax withholding estimator to find out if you've been withholding the right amount all along. Here's how you can take action. If you need to make adjustments, file a new W-4 at your workplace. If you can swing it, choose zero allowances so you pay a larger chunk of taxes throughout the year. If the calculator shows you've been withholding too much, file a new W-4 and increase the number of your allowances to increase your monthly cash flow going forward. Number 2 is a huge one, and you still have an opportunity to make some adjustments here. Max out your retirement account contributions. Tax-advantaged retirement accounts, such as traditional IRAs or 401k plans, compound over time and are funded with pre-tax dollars. That makes them a great investment in your future. They're also helpful at tax time, since any contributions you to these plans lower your current taxable income. For the current tax year, the maximum allowable 401k contributions for an employee is $19,500 if you're age 49 or younger. If you're age 50 or more, you can actually contribute $26,000 in the current year. This includes a $6,500 catch-up contribution. So you want to take advantage of this ability to add more to your retirement plan and reduce your taxable income at the same time. For the current year, the maximum allowable IRA contributions are as follows: $6,000 up to age 49 and $7,000 if you're age 50 or more. This includes a $1,000 catch-up contribution as well. Now, if you're self-employed and have the opportunity to contribute to a SEP IRA, you can contribute as much as 25% of your self-employment income, or $58,000. You could also benefit potentially from a solo 401k plan and or a solo defined benefit plan. This combination actually allows you to sock away substantial amounts of revenue from your business, effectively giving you a nice sized business tax deduction, while also transferring these funds to grow your personal wealth at the same time. So you want to make sure you're looking at what are things that you can do to transfer wealth from your business to the personal side and give you the best tax deductions in the process, both now for your business and later down the road when you start taking the money out as income. The other area is if you have an HSA, a health savings account, consider maxing out the contributions that account as well. So on this type of account as well. So currently you can put away $3,650 for individuals, and you can actually sock away $7,300 for families. And in addition to that, and this is a little bit different than the catch-up provision, you can contribute an additional $1,000 for individuals age 55 and older. So this is a really great opportunity for those of you who are already maximizing your employee contributions, whether you're a W-2 employee or if you're a self-employed person with a 401k, a solo 401k. If you've maxed those out and you still need additional contributions to help with your retirement planning, you can actually contribute these pre-tax dollars to your HSA savings account. Unlike a flex savings account, you don't have to use the funds in the current year that you've contributed them. An HSA account can continue to roll over and grow tax deferred. Most of us know we're going to have health situations as we get older. It's a great tool to combine for your retirement planning. So here's how you can take action. Can't make the maximum contribution to your 401k? Try at least to contribute the amount your employer is willing to match. So if they're matching $50 up to 6%, then contribute that 6%. Match 3% total, and that gives you 9% going into your retirement account. Okay, all 401k contributions must be made by December 31st as an employee. So if you're paying yourself as a self-employed person a salary, you need to make sure you include your employee portion. You're the employee and the employer. You have to make sure you include your employee portion of the contributions in your payroll by December 31st to be able to contribute to your own plan. Okay, you can make contributions to IRAs and HSAs up to the tax deadline each year. But here's a note. My clients, especially my business clients that contribute to their own plans throughout the year, hands down contribute a substantially larger amount to the retirement plans versus business owners that wait until they get their taxes prepared. They find out they have a large tax bill. The tax person or CPA tells them, well, you can contribute $58,000 to a SEP IRA still up till tax filing. That will lower your tax bill. You'll still have a tax bill, and you have to come up with $58,000 to fund your retirement. So in the end, you're still having to come up with funds to both pay the taxes, even if it's reduced, and contribute to your retirement plan. If you take this fourth quarter of the year and look at the adjustments that you can make right now, then going into the year 2022, you can make contributions on a regular basis throughout the year to maximize your contributions going forward. And again, hands down, my clients that do this on a monthly or quarterly basis versus an annual basis, they actually contribute a substantially larger amount than clients that try to do it all in one lump sum. The third tip is take any RMDs or required minimum distributions from traditional retirement accounts if you're age 72 or older. This is up from age 70 and a half, by the way. So I have clients calling me all the time asking about the required minimum distributions. And if they hadn't hit age 70 and a half as of last year, I was able to give them the good news that they don't have to take those funds out until they're age 72 and older. But why is this important? All employer-sponsored retirement plans, traditional IRAs, and SEP IRAs and simple IRAs require regular minimum distributions, or what's called RMDs. And this is required by the April 1st that follows the year you turn age 72. Thereafter, annual withdrawals must happen by December 31st to avoid the penalty. Now, most of us know that when you're contributing to your 401k plan and your IRAs and your SEP IRAs and such, if you're contributing, all along before age 59 and a half, and you withdraw funds from those types of plans, you actually have a penalty, a tax penalty of a premature withdrawal of 10%. And that always seems pretty substantial to most people. You've taken the time to put these funds away, but if for some reason you didn't plan properly and you needed to take those monies out before age 59 and a half, then not only are you going to pay ordinary income tax on the amounts that you take out, but you're going to pay a 10% penalty on top of that. That seems pretty hefty enough. However, when we talk about required minimum distributions, RMDs, these are also considered taxable income, even though the IRS is forcing you to take the money. But if you don't take the required minimum distribution, you face even a more substantial excise tax of 50% on the amount you should have withdrawn based on your age, life expectancy, and beginning of the year account balances. So you want to make sure you don't miss that RMD. Clients that work with us, we help monitor this for them. We put it into their financial planning so they really don't have to worry about it. But it's something that If you're doing this on your own, if you're a DIYer, you want to make sure that you don't miss your required minimum distribution, because even if you don't need the money, it's better to take that money than lose 50% of the hard-earned money that you've worked so hard for. So what kind of action can you take? Take your required minimum distributions by December 31st. Once you turn 72, you must take your first withdrawal on or before April 1st the following year to avoid the penalty. If you don't need the cash flow and would prefer not to increase your taxable income, you may want to consider what's called a qualified charitable distribution, a QCD. You do this directly from your qualified account to a public charity. However, you won't get the charitable contribution itemized deduction with that same as you would a normal charitable contribution. QCDs are limited to $100,000 per year, and you can make a QCD gift as early as age 70 and a half still. All right, tip number 4, harvest your investment losses to offset your gains. This is huge. Tax loss harvesting is a strategy by which you sell taxable investment assets such as stocks, bonds, and mutual funds at a loss to lower your tax liability. You can apply this loss against capital gains elsewhere in your portfolio, which reduces the capital gains tax you would owe. In a year when your capital losses outweigh your gains, the IRS does let you apply up to $3,000 in losses against your other income, and you can carry forward the remaining losses to offset income in future years. The goal of tax loss harvesting is to potentially defer income taxes many years into the future, ideally until after you retire, when you'd likely be in a lower tax bracket potentially. This process lets your portfolio grow and compound more quickly than it would if you had to take money from it to pay the taxes on its gains. So how can you take action? Tax loss harvesting requires you to diligently track tax losses across the portfolio, as well as monitor market movements, since the chance for tax loss harvesting can occur at any time. A financial professional can help you identify any losses you can use to offset any gains. And here's a note. Tax loss harvesting does not apply to tax advantage accounts such as traditional IRAs, Roths, and SEP IRAs, 401ks, and 429 plans. These are from your individual accounts. Tip number 5, think about bunching your itemized deductions. Certain expenses, such as the list I'm going to go through, can be classified as itemized deductions. Things such as medical and dental expenses, deductible taxes, qualified mortgage interest, including points for buyers, investment interest on net investment income, charitable contributions, and casualty, disaster, and theft losses. In order to itemize, your expenses in each category must be higher than a certain percentage of your adjusted gross income, or your AGI. For example, let's say you'd like to itemize your medical expenses. For the year 2021, for that tax year, the threshold for itemizing medical expenses is 7.5% of your adjusted gross income. If your medical expenses total 5% of your AGI, it wouldn't be beneficial to itemize. So bunching is a way to reach that minimum threshold. In this example, you could delay 2.5% of your expenses to the following year, and then you'd be more likely to reach the minimum 7.5% of AGI that next tax season, allowing you to itemize. So how can you take action here? If you've been waiting on certain medical and dental expenses or charitable contributions, you might want to group these expenses to take the most advantage of itemizing the deductions. And the last tip we're going to talk about today, number 6, spend any leftover funds in your flexible spending account, your FSA. This is different than your HSA, your health savings account, which allows you to carry over unused balances. Flexible spending accounts are a little bit different than the HSA. FSAs are basically bank accounts for out-of-pocket healthcare costs. An FSA earmarks your pre-tax dollars for medical expenses, lowering your taxable income. When you tell your employer how much of each paycheck to set aside for your FSA, remember you'll pay taxes on any funds still in the account on December 31st. Plus, you'll lose access to the money unless your employer allows a certain amount in rollovers for the next calendar year. So, how can you take action here? Schedule any last minute checkups and eye exams by December 31st. Fill prescriptions for you and your family. Still carrying a balance on this account at the end of the day, stock up on items approved for the flexible spending account. This could be things like contact lenses, eyeglasses, bandages, things of that nature. So the key here is you don't want to lose the money that you've actually set aside. So make sure you plan for this before December 31st so you can take full advantage. And here's a note. Some employers give you until March of the following year to use your flexible spending account dollars, but you must look at your employer benefits to determine this. And if you're self-employed, you can have either a flexible spending account or a health savings account to have the same advantages that a W-2 employee would have. With a little planning before the year ends, you can better prepare for the upcoming tax season. In addition to that, if you make this a habit, and you make sure you do some fourth quarter tax planning, then you can carry that planning over into the new year and take more advantage of the tax strategies available to you. If you're not sure how these strategies might work for you, take advantage of our complimentary consultation. We'd love to talk to you about this. We save our clients tens of thousands of dollars a year, currently and in the future, by doing tax planning with them on a regular basis. Thanks everyone for joining us. We'll see you next week on Friday's Focus on Finances.